side.
Dirty souls of wolves are hauling. Can you hear the voices calling? Do you feel how they are dragging, waiting for a second to push you to your limits, going stronger, feeling better? But do you feel them? Can you hear them say?
Welcome to the Retirement Learning Lab. This is Van Richards, and this is the daily NASDAQ update. Welcome to our show today. We have a whole lot of information to cover for you. The idea of our show is we help you to learn how to retire without running out of money. Now, we're going to talk about stocks a lot today, and we're going to talk about what happened going around the world. So let's get started and look at what happened in the markets for today. Generally speaking, the markets were off today in the United States, and Europe was up, and then China was down. Let's take a look and see exactly what happened, more detail. You can see the NASDAQ lost about 0.5%. The rest of the markets were down. We've been up pretty well for the last couple of days, so it's actually a little bit of a letting off the steam, and there's some other things that are going on in the economy. The Federal Reserve came out and basically said that the picture for the future wasn't quite as rosy as what was anticipated. There are a couple of other things that went on today that affected the markets. In Europe, though, we saw the Paris exchange up, and then when we skip on over to the Asia markets were down. There's a lot of different things going on here. We saw that the Shanghai led things going down. The Hang Seng was down also. There's a lot of pressure in China right now on the markets from U.S.-China relations. Actually, today, the United States government put pressure on endowments at universities to diversify themselves away from Chinese stocks. And there's a couple other things. We're going to be talking about a Chinese stock today when we talk about Baidu. If you haven't heard of Baidu, you'll know a lot about it by the time the day's over. If we skip on up to Canada, we saw the markets were off. The Toronto Small Stock Venture Fund or Venture Index was down the most. And then we get into the feature stocks of what we're going to talk about today is Broadcom and Baidu. Broadcom and Baidu are completely different stocks when we look at how they operate and what they do. Baidu is what Google is to the United States. If you were in China and you were going to look something up, you wouldn't Google it, you would Baidu it. I'm sure that there's a phrase to put that in Chinese, but you would Baidu it rather than Google it. Here in the United States, we also look at Broadcom. Broadcom is a large tech company that has a large diversified base. And let's take a look a little bit more about what they did in the markets today and what they do individually as stocks. If we go over, I'm going to throw in the spaghetti graph of what happened today. If you take a look at the green line that you'll see right here, this was the general index. This is the NASDAQ 100. This is the 100 largest stocks in the NASDAQ. Remember, the NASDAQ is made up of about 3,500 stocks that are traded on the NASDAQ exchange. It's quite a unique exchange because most of it, or it's actually all done electronically. There are no in-person trading the way that there is with the New York Stock Exchange. This is what happened in the NASDAQ 100. And when we compare that and look at what happened at Baidu, Baidu was down at the beginning of the day and then regained. We saw the opposite happen with Broadcom, where they jumped up at the beginning of the day. They kept going, but they lost their steam toward the end of the day. Now, let's take a look at this over the past 6 months. If you look at these two stocks in comparison to the NASDAQ index, the index, as you can see, is in green. And you see Broadcom is in blue, and then Baidu is in red. And you're going to see why Baidu is lagging behind the index in just a moment. When we look at Broadcom has a diversified array of different products. They make smartphone communications. They're actually the ones that make the speakers in high-end phones. They also are involved in semiconductors, broadband products, infrastructure, and software security. They purchased Symantec recently, so they've gotten into the security aspects of technology as well. If we look at what happened after their revenues were declared recently, they were down about 2% for the quarter from the previous quarter, but up about 4% from the previous year. If we go over and look at the spaghetti graph of what happened, this is right around June 4th when they declared their earnings. And then we can see actually it fell just a little bit the days afterwards, but it's come back significantly with the rest of the market recently. And we kind of jump over here. And if you follow my dancing cursor, if you follow me in the last few days, you can see that this is where the market fell in between February and March, and then it went back up. Now, when we look at what's going on at Broadcom, Broadcom has a narrow moat. Now, if you haven't joined me before, you might be asking yourself, what exactly is a moat? This is a moat. A moat describes the profitability potential for a company. If a company competes very well with other companies similar to it, then it has a broad moat. If it has a lot of competition that could take away business or could infringe upon profits, then it has a narrow moat. And if you visited with me yesterday, you saw that there were companies that we talked about that have no moat. Essentially, they have no protection against outside. When we look at Broadcom, Broadcom has what's referred to as a narrow moat. They are dependent upon a lot of large customers like Apple and companies that depend upon using their technology. And if they give up that technology to that advantage to other companies, then that's a big loss for them from that standpoint. So competition is high. Another thing that goes on at Broadcom is they are very acquisition driven. They may buy and sell different aspects of the company from a corporate standpoint. So that can affect the moat ability of it too. So let's move on. Gee, I made a funny there, a moat ability. Although I can't hear you laughing, I know you are. All right, so let's look at what the analysts are saying about Broadcom. They give it 3 stars. Now, this is from Morningstar. They look at the value, the fair market value of this as being $310 a share. They closed today at $329.21. So it's pretty close to actually what their fair value is. Now, let me talk about this just for a moment, because I think it's important that you understand the idea of value when we talk about stocks. A value stock is a stock that's trading close to what its book value is. Now, book value is basically, I think a simplified explanation of it is going to be, what if you sold all the assets of the company? This is what the book value would be. There's no hype in the value. There's no hyperbole that's going on. It's just, that's what it is. But you look at other companies out there like Apple, for example. Apple is not a value stock. The biggest reason is because it's overvalued. It's far over top of what its actual projections are. It's interesting, though, because the analysts can be proven wrong a whole lot, like today, where we saw Apple go into rare territory, and it is actually a $2 trillion company today. So when we look at the value of stocks and we say we have a value stock, that means that it's trading to what the analysts think is closer to the book value. Now, there are some people out there that say value stocks are dead. Well, that would mean that they don't grow very much. Now, that may be true, but we have to look at it from the standpoint of reality. And if a stock has gone up significantly, it's a possibility that it is overvalued. Now, we don't have a category for overvalue versus value. But I think there probably should be one at this point because there are a lot of stocks that have advanced quite a bit. Because if we look at how far that we've come back up in the market from between February and March, there's a significant gain in there. And there will probably be some of the market relief at some point in time for whatever occurrence that may be happening. So let's get back to it and talk a little bit more about valuation in here. Now, this is a significant benefit. I love this idea about Broadcom, and I think you will.
The beauty of your side.
If you are retired, you may be looking from the standpoint that there's not a lot coming from dividends on stocks. There's not a lot coming from dividend stocks at all. So when you find stocks that have high dividends like Broadcom, you want to hang on to them because it's a quality stock that pays a regular dividend. If we look at it compared to what's going on in bonds as a parity, not really as a comparison, because remember, bonds are going to have a lot more security. When you have a 10-year treasury bond that actually closed today about 0.68%, up a little bit, I believe it was about at 0.68, compared to the 3.96% rate of dividends that you have potential from Broadcom, that's a big difference. Now, the big difference, obviously, is that when you have a bond, like a government bond, you've got the government standing behind it, and you know it's going to continue to pay. When you have a stock has a lot of variability in there. But for some of you who are looking for income, you may consider looking at some high-quality stocks. Broadcom is one of those that you might consider. You have to be willing to accept some of the risk that goes along with it, but with that risk, there may be some reward not only in value increasing, but also in dividends that's associated with it. Now, it's really easy for us to put together a dividend portfolio, and that's actually what we do sometimes with a technique called direct indexing. We'll look at high quality stocks. Say, for example, we take the 100 stocks in the NASDAQ 100 and we just pull out the dividend paying stocks because those are the ones that would pay dividends into your account and then they would be paid to you as income. Now, you have to understand that there's quite a bit of variability that can go into this because when we're talking about dividends from stocks, there's not the kind of guarantees that there are that are associated with bonds. So you have to be able to tolerate some of the variability that's associated with it. Now, if you were to look at the dividend paying effects of stocks over a 10-year period, for example, you're going to notice that the value increased quite a bit because of dividends. When those pile back in as you go along, that adds to the valuation in total of the total portfolio, especially if you're buying more stocks with the dividends that you acquire. But there again, remember, we're talking about values that can fluctuate. So you have to understand, remember that old phrase that the past performance of an investment is no guarantee of its future results. Oh, that reminds me too. When you get to the end of this video, make sure that you watch the disclosure because it talks about all the legal stuff that you need to be aware of. So let's get back into talking about the investments that we have for today. All right, Baidu. Baidu is the largest search engine in China. And I mentioned to you earlier, if you were in China and you were going to look up directions someplace, you wouldn't look on Google Maps, you would look on Baidu Maps. If you were to look up where a restaurant was, you probably wouldn't use Yelp, you would use Baidu. Baidu is the largest search engine in China, and it is available in the United States currently as an ADR. ADR stands for American Depository Receipt. Now, the idea there is that you can purchase this stock, which is an international stock, through a U.S. exchange. It is actually traded on the NASDAQ. Let's go on and look at a little bit more information that's in here. Now, this is something that's going to affect the valuation going forward on a lot of Chinese stocks, not just Baidu. The Trump administration has said that they are suggesting that companies like Baidu be delisted. Now, why would you want to delist a company from an exchange? One of the biggest reasons is that they don't follow general accounting principles. Now, if you just follow investments in general, you may not be aware of this. So I want to help educate you just a little bit because we're all about education here and understanding how stocks work. When a company files it's with the Securities and Exchange Commission, when a U.S. company files, they file under what's called GAAP, or General Accepted Accounting Principles. This is a standard that's set out by the United States government, and companies follow it when they file. But the big problem that occurs is that the Chinese general accounting principles are not even close to what the United States general accounting principles are. It's actually generally accepted accounting principles. They're not even similar. And you're going to see a little bit more about that when we talk about some of the ownership, because ownership in the United States with stocks is quite regulated. But with Chinese stocks, it's kind of up in the air from that standpoint. Let's take a look and see exactly what I'm talking about in all this. Another problem that's going on with Baidu right now, they are under extreme legal pressure. If you were to Google Baidu today, Google Baidu, or if you could Baidu Google. Okay, if you don't get it, I'll go on. The idea is if you were to look on Google for Baidu, you would see that there's actually quite a few lawsuits that have been filed in the United States. The reason is because there are a lot of shareholders that are thinking that their valuation is not accurate. So you're finding a lot of law firms out there that are putting together or trying to put together class action lawsuits against Baidu so that they can recoup values that have possibly been lost. Chinese accounting principles are vastly different than the United States accounting principles. Now, this is kind of interesting because when you look at what analysts are saying, when we look at what the analysts are saying at Morningstar, the Morningstar people are actually rating this as a 4-star company. That's because they're saying that there's a lot of potential there. They're ignoring, now they're not wrong, I'm not saying that, but they're ignoring some of the noise that's going on right now with the China-US relations. And in doing that, they're just looking at how the company operates. It's a huge company. They have close to 1 billion users, at least in China. And when we look at the valuations of it, the reason that they give it a 4-star rating is because they say that it's undervalued. And that could be because of what's going on in between the United States and between China, of course. But the close today was $124.20, and they're looking at the fair value as being $194. That's a big difference. Now, if you were just interested in profits and you were willing to take the risk, then this would be considered a value stock. Now, is this dead? Probably not, because Baidu's not going to go away. How it's controlled and how it's operated is vastly different than those in the United States. But for those who are willing to take the risk on it, then it's possible that it could pay off for some money for you going down the road. This is what happened with Baidu over the past 3 months. Now, their valuation, they had their, as you can see where the red arrow is blinking right here, this is where they gave their earnings, their earnings call that happened, I believe it was just recently on August the 13th. And then if we compare what's happened to Baidu over the past 6 months, and we're talking about Baidu since the market fell back in between February and March, and I know I bring this up every day when we talk about stocks, but if you follow the dancing cursor under this red flashing arrow, you'll see where Baidu went down, and it has come back of, I guess maybe about 2 months ago. It's decreased off that, and the decrease that we're seeing is actually, I think that it's a lot because of what's going on with the pressure and the relations between the United States and China. Now, it's been very interesting that the Biden administration, the potential Biden administration, has not made any comments whatsoever about how the United States should deal with Chinese stocks. So it'll be interesting to see how that comes out. There are some other people out there that have another prediction, and I want to talk to you about this just a little bit, because if we look at stock market valuations, this is what the stock market is saying. Now, remember that the stock market is not really a person, okay? But it says things, it tells us things. It's almost like a Ouija board, maybe. But the idea is that stocks move in anticipation of what the market sees is going to happen, what they anticipate is going to happen. That's what pushes markets forward. Now, what's interesting, I think, is that last night, Joe Biden was basically nominated as the candidate for the Democrat Party for the United States president. But the stock market is continuing to move higher slightly. Now, you might say, what difference is that? What effect does that have? Okay. The stock market moves in anticipation of what they think is going to happen. If they think that things are going to, I'm saying, I'm giving it a personality right now. If they think the market thinks that the market is going to be status quo, it's going to continue to move up. If we see a administration that's going to be unfriendly to companies, and when I say unfriendly, the Biden administration will put a lot of stress on companies from the standpoint of taxes. So what is happening here is, even though that there's an anticipation that there could be higher taxes, why is the market going higher? Well, maybe the market's telling you that they're not anticipating any change in the administration. No, I'm not saying that. I'm saying the market's saying that. So keep that in mind when you look at the stock market going forward. Okay, let's go back to the stocks that we're talking about today and finish looking at Baidu. All right. Now, when we look at the moat of Baidu, do you remember what a moat is? Okay, this is a moat. Okay, if you look at the moat that's right over here, you're going to see that it's a wide moat. Now, you might be asking me, well, I've been talking about all of these bad things that could happen to Baidu. Why would it have a wide moat? Remember, wide moat talks about profitability. Let's go away from all of the noise that's going on with the arguments in between the United States and China. And let's look at this from the standpoint of market share. The market share of Baidu in China is significant. They've been around since the 70s. They are significantly entrenched into that economy, and we probably aren't going to see much change in that, even if relations in between the United States and China wither away. So from a profitability standpoint, this company still has a wide moat. They don't have a lot of competitors. Actually, in China, Google pulled out because they didn't want to deal with the regulations that was associated with it. And there has been some rumors that they may try to go back into China. But right now, the primary search engine in China is Baidu, not Google. So the competition there's not as much of it, and they have a wide moat. They have a very substantial market share. They're established, and they have close to 1 billion users, 1 billion with a B. That's a big number. That's not going to go away. That's why the profitability moat on a company like this is pretty big. But there's a couple other things that you need to be aware of that's going on there too, because if you're buying this stock from the United States, this can change dramatically. Now, when we talk about insider trading, we're usually talking about the people that are working for the company and how they are buying and selling stocks. When we deal with ADRs, remember, ADRs are not really United States stocks. ADRs are stocks of foreign companies that are traded on United States exchanges. When we look at Baidu, Baidu is a Chinese stock that's being traded on the NASDAQ. It has, obviously, from what we talked about a few minutes ago, it has the potential to be delisted. That would mean that it's not allowed to trade in the United States anymore. But that's not the end of the story. You see, one of the reasons why Morningstar has continued to give this company a good rating and give it a wide moat, that means it has a good potential for profit, is because it's not traded as a Chinese company. Baidu is actually registered in the Cayman Islands. It's not registered in China. So it's a good possibility that you could still trade this stock even though that it's delisted from the NASDAQ. So if you actually own Baidu and you might be thinking, I need to sell this if they're not going to be listed on the NASDAQ anymore, the company's just not going to go away. Remember, they have 1 billion users in China. It's not going to go away real soon. But when we look at insider trading and we look at generally accepted accounting principles, this next fact is significant. Okay, I want to make this just a little bit bigger because this is important to talk about. They have 2 types of shares that are offered to the public with Baidu. They have A shares that most people get, and then they have B shares. Now, the interesting thing is that the B shares are the shares that are owned primarily by the executives of the company. The chief executive officer of the company that's been around from the very beginning of it, Robin Lee, I think that's how you pronounce it. I apologize, Mr. Lee, if you're listening and I got your name wrong. But the point is, this gentleman owns only 16.4% of the company. So he would be considered a minority shareholder in the United States. He is not considered a minority shareholder because he owns so many Class B shares. Class B shares gives the owner about 10 times the number of voting rights of that of a Class A share. So even though he owns a little bit over 16% of the company, he controls over 55% of the company. Now, that's pretty big when we look at the idea of controlling what's going on with the company. And you'll find that most of the company is controlled by executives. Even though we can't tell who's buying and selling inside of the company the way that we do with an American company, we know that the control of the company is entrenched in the executives, and they control whatever goes on with it. Now, that creates a few other problems when we talk about the ESG here in just a moment. So let's move on and see how that works. First off, before we do that, let's talk about the insiders buying and selling in Broadcom. Because Broadcom is a U.S. company that's traded on the NASDAQ. And you're going to, if you look at this, you can't see the exact numbers. I'll just tell you, there's a lot more sellers here than there are buyers. If you look in the last 3 months, there are 91 inside sellers compared to only 12 buyers. Now, Broadcom is not significantly overbought, but there's a lot of people that are looking at this company from the inside. A lot of the people, the executives that own stocks in this company, and they're selling. So I think you just have to take that with a grain of salt. If I was going to be investing significantly in this company, I'd investigate it just a little bit more to get an idea of why so many executives have been selling over the past year. Over the past year, it's been basically from the standpoint of a 5-to-1 sells to buys. Over the past 12 months, we've seen 203 sells to 50 buys inside of Broadcom. So something's going on. I don't know what. It's considered a fair market value, close to it when we look at the Morningstar ratings, but there's a lot more sellers than there are buyers that are going on. So take that with what it's may. I'm not telling you need to go out and sell this stock if you own it. I think you need to investigate it a little bit more. Let's move on. Let's compare these two stocks when we look at valuation. Now remember, Morningstar rated Broadcom as a 3-star and Baidu as a 4-star. When we look at the valuation, though, we can kind of get an idea of how this works. Remember, when we talk about Morningstar ratings and people say, oh, it's a 5-star company, that's not meaning that, they won the popularity contest. What it means is that that company has the potential for being undervalued. You could have a potential profit, a bigger potential profit by buying into a company like that. That's what Morningstar is telling you when they tell you about their star system. And when we look at their star system and we say Baidu is rated as a 4-star stock, the reason is today's close was 24.20 and the fair market value was 109. Fair market value was 194. So There's potential there. Broadcom, not as much. Remember, this is just an analyst opinion, though. It's a hypothetical fair value. It's not something that's written in stone. And just like I've told you before, the past performance of stocks is not a guarantee of the future results. But take what I've said and put it into your mix of understanding and your needs, and use that the best way that you can for your own particular situation. Everybody's different. Okay, let's move on now. Let's talk about the ESG. I put this chart up here every day, and if you've watched me before, you get the idea of how this works. We have the bad ESG versus the good ESG. On the top, we've got nuclear power and GMO and weapons and animal testing and gambling and alcohol and pornography. Those are all the bad things that are out there. You don't want to buy those companies if you're sensitive to ESG or to biblically responsible investing. Well, let's talk about that, just the details of it just a little bit more, because Baidu and Broadcom don't rate very well when we look at what MSCI says about these companies. They rate these companies pretty low from that standpoint. So if you were buying companies and you said, you know, I'd like to have a clean company, a company that's conscientious about the environment, a company that's conscientious about what's going on in the social issues of the world, a company that is responsible of governance. Well, I can go back and tell you that one of the reasons that that Baidu rates low from a governance standpoint is because you've got basically two guys that are running the company that have been running it forever that makes it do anything they want. And is that a good thing from a governance standpoint? Oh, I don't think so. But if you're okay with that, just ignore this. Okay, moving on though. If we look at what else is going on, when we look at Baidu from the standpoint of the individual aspects of ESG, MSCI is saying that corporate governance, we talked about that just a little bit ago, or a moment ago, they're below that. Corruption and instability. Well, there was actually something that occurred back in 2016 that was where they were. See, what happens is with Baidu is that you can pay for rankings. And there was a young man that was looking up cancer treatments because he was dying of cancer. He went with the top rated recommendation that Baidu had for this particular cancer treatment. Well, regretfully, he died. And the issue became a really big black eye for Baidu because they were selling popularity. And by selling popularity, they basically sold a product or pushed a product off on someone for an illness, and it wasn't a good situation. So when we talk about corruption and instability, MSCI is probably looking at these particular issues like that and taking that into consideration. So let's move on just a little bit because we don't want to run too much on time. You know, I didn't talk anything today about the biblically responsible issues with Baidu because I think there's just too much going on there. I use a company called Inspire normally, and they actually gave Baidu a positive rating. But I'm not in total agreement with that. So I didn't really put it up here, but I just wanted to mention it because if you were considering a biblically responsible portfolio, you might want to think twice about using a company like Baidu because of what's going on from a corporate governance standpoint. There's other issues that go on there that we don't really understand fully what happens within the company. So this is a good lesson too, that one company's rating is not your opinion. It shouldn't be your opinion. Just like if you listen to one news service, you shouldn't use one news service as the gospel for whatever the news is. Gosh, that's something that's significant, universal nowadays. The idea of fake news has become prevalent. It's become a new buzzword of the 2020s. So keep that in mind as we're looking at some of these companies. And if we go on, let's look at Broadcom too. Broadcom, I don't want to paint them in the same picture as Baidu when it comes to ESG, but MSCI, who does rate these issues, and they look at the significance and they look at this in a lot of depth, and they didn't rate Broadcom very well. If we look at some of the different individual issues, their human capital development, supposedly they are using some controversial sourcing on some of their different products. You might want to look at this. If ESG is important to you, Broadcom and Baidu might want to go under a microscope for you so that you can really look at what's going on there. Now, just kind of as a parity between the two, and when I say parity, I don't mean comparison. I do mean parity, because they're kind of jokingly compared to each other. And that is when we're looking at the biblically responsible ratings compared to the ESG ratings. The ESG ratings for Broadcom were not very good. But when we look at the biblically responsible ratings, they're fair from that standpoint. So you got to ask a lot more questions when you look at issues like this. I probably didn't answer a lot of different questions for you today when it came to talking about ESG and biblically responsible investments, because I showed two opposites, two ends of the spectrum. I showed one company that said, hey, this is great. Another rating company that said, this is bad. So you have to look at it from your standpoint. And that's one of the big problems that I think that exists today when we're talking about ESG, or environmental, social, and governance ratings. There are a lot of companies out there, from MSCI to Morningstar, SSI, Inspire. All these different companies are trying to give you their opinion on how morally superior one company is over the other. You have to look at it from your own individual standpoint, and look at it from your standpoint and build your own portfolio. Now, one of the things that I suggest to people to do, if you want to invest in stocks and you do want to be conscious about either biblically responsible investing, or you want to be more conscientious of the attributes of ESG, then build your own portfolio. Put your principles down of what you believe in. If you're vegan and you believe that animal testing is bad, then you want to do away with all those companies. If you are Christian and you believe that some of the principles that Christians believe in should not be in your portfolio, then pick stocks that's going to fit that. There's a technique that's called direct indexing, where you could pick an index like the S&P 500 or the NASDAQ 100, and you could pull out just the stocks that don't fit your criteria, and you could hold them because you believe in them. And I think that if we look at that from a personal principle standpoint, if we're getting ready to retire, if a person's getting ready to retire, you're probably more concerned about where you're going to spend eternity than you are where you're spending today. Now, you want to have income. You can't live off of soap, so you have to have income. But the idea is you may be more conscientious of what's happening with your money. And if you are, look into it. Look into the idea of direct indexing. Don't ignore the risk that's associated with it. In just a moment, I'm going to let you read a disclosure, and I think you should do that to make sure that you understand the risk that's involved. But if you want to talk to me about your particular investments, and let's put this back up here just for a moment. If you go to my website, which is richardsfinancialplanning.com, we design retirement plans that do help people avoid running out of money during retirement. And we can help do that for you. And if you would like to talk to us, go to the teal colored button that says schedule a call to learn more. Click on that. It'll bring you up to a calendar, and then you can schedule a 15 or 20-minute conversation with me. And we can talk about your situation and how the ideas that we've talked about today, or something else that you've got in mind, how that I might be able to give you some help, or perhaps we find out whether we have a working basis or not. But the call is free, so take advantage of it if you'd like. Okay, that ends everything for today. I'd like to thank you for joining me, and come back tomorrow because we'll bring up some other companies. I believe tomorrow we're talking about Amgen, and I can't remember the other company that's out there. Actually, come back tomorrow. We'll talk about more NASDAQ stocks. Stay tuned, if you would, for the disclosure, and have a great day.